Hey guys, welcome to another Trade Genius podcast. Bob and Phil here as always. Guys, the Fed's been lying to us. They're more scared than they're admitting. We're going to talk to you about why. So let's dive into this video.
Trade Genius.
Hey guys, I want to tell you something that we do that really will change the way in which you look at trading and also absolutely help you increase your profitability and how much money you make. It's the Trade Genius newsletter. We put the newsletter out Sunday night through Thursday night, and this really looks at the plumbing of the markets and helps prepare you for the next trading day and help you make money. And we give you a lot of information. We give you market statistics, we give you market levels, we give you the seasonality, what's happening with different sectors of the market, and we will help you identify whether the market's in a bear mode or a bull mode, or whether it's euphoric, whether it's despondent, and it just puts you in a position to be on the right side of the trade. So take advantage of our offer that we have below, and you'll love it. I mean, one trade that you make with this thing can pay for definitely a month, maybe even a year's worth of service. It's that powerful. Use promo code podcast for 15% off the retail price of newsletter. Thanks for listening.
Okay, Bob, give us the goods. What's going on with the Fed?
It's pretty funny because we're kind of joking over the weekend, and how can you tell when Yellen's lying is when she opens her mouth, and everything's safe and sound with the banks, but obviously the banks are in big trouble. But the Fed has an index called the diffusion index, which it's the aggregate of all the Fed governors, and they're in a situation here where they're actually predicting. This is predictive modeling on their part of how they feel the future leading indicators are going to be. And it's below basically the 2007, 2008, below the pandemic low. And so they're calling for a total wipeout, Phil. Check out this number.
Yeah, that's wild.
It's scary. I mean, look at that, and look how fast it plunged. And that's the thing. That's the non sequitur in my mind is Powell looks at this thing every day, and so we talked about this before. Is I think what Powell's doing is more than just inflation. I think he's doing chemotherapy, and he's taking these people right down to the end, and trying to protect the dollar because of what's going on around the world here. But man, it's going to be. I think people don't quite grasp what that's going to mean for the stock market. And I threw a definition up to people can read it if you want to throw it up there. Okay, this diffusion index by the Fed governors. Okay, and they're calling for basically an economic wipeout.
Wow,
just amazing.
Yeah.
And what does that mean for SPY? Hey Phil, do you want to go to Paris and see the Eiffel Tower?
Always.
Well, I'm going to show you a different Eiffel Tower that's scarier than the one in Paris.
Okay.
Here's a chart of SPY. Now, you and I we look at a lot of bubbles and a lot of these Eiffel Towers, and I just want to explain to people who are listening is that when you have a bubble move, and I think we can safely say that this move with SPY is a bubble move. I've taken this back only to the 2009 low. You could go back all the way down to the 1991 low if you wanted to, and extrapolate it even further. But I took it to that low because I think it still shows and proves the point here is that we had a move here for the last 15 years of constant Fed accommodation, and that switch flipped at the end of 21, beginning of 22. An Eiffel Tower move is a retracement of approximately 78%, even more of the move from the high to low, but the collapse is accelerated. The mark goes up on an escalator, comes down on an elevator. And if this proves out to be truly a bubble, if they don't truncate this by massive amounts of Fed liquidity to try to blow up another bubble here, which I don't think they can, and I'll explain that to you in a minute, then I think there's a really good chance that we're going to go through and down into and around SPY 1600. Let's call it 1.5 to 2 years from now, Phil. And I want to get your kind of thoughts on that. Do you buy that? Now, there's a couple stop signs along the way, as you can see where these fib lines are and earlier support. But I just want to kind of get your thoughts on that before I continue on with my explanation.
Well, I was going to transition over to just real briefly. We can go back to that chart, but the Fed liquidity chart, which we're getting ready to release for you guys. But basically, I always go back to where the COVID panic pump started. And we've shown this before, but maybe for some of the newer subscribers, we're expecting this to come back quite a bit. And that's why the Fed's still being stubborn about the interest rates and things like that, even though there's this banking crisis in the headlines. But they've effectively plugged the holes, at least in the short term, so that there's not a cascading effect from bank losses. And it's because he wants to continue on the rate hike regime until they get to their terminal rate. And the market continually tries to call their bluff. And I keep going back to what Kashkari said late last year about if they're going to play chicken with us, they're going to lose, meaning that they're not going to let much get in the way short of, global contagion that they can't control. But if it's these domestic banks that are failing, they're going to go right in there and plug the gap. I mean, look how fast the FDIC went in on Silicon Valley Bank over the weekend. I mean, they were there. They heard about it on Thursday, Friday. They were there over the weekend, making sure that customer deposits were available. So that tells me that they're very much on the mission to get to their terminal rate goals, which could be as high as 6%. And they want to get this liquidity back out of the system. But I show this chart because it shows you just how much they put in, how much fluff is in the system. And we were talking today about some different charts. And, my view is that if you look on a weekly chart, I think most stocks and or commodities, and it doesn't matter what it is going to have more downside as things come off. Because one thing, you can look at commodities and certain things, Bitcoin and gold, and over the long term, they'll probably outperform the market as we go back down, but they're still all going to feel the effects of coming back down. Because when there's broad risk off, especially when you're deflating a fake bubble, because this is a fake bubble. I mean, you can look at the trend line that we had going up into this, and you could argue that really we should be around 32 to 3,400 if we maintain that growth, right? But until we get down to those levels, I think you have to be risk adverse in this environment right now. And we have other issues too across the pond in Europe. I think their banking situation is much worse than us. And that can also be another, contagion type thing. And that's why also the Fed opened up daily swap lines. See, they only used to have weekly swap lines, and it was a 7-day rolling swap. And the European Central Bank would take out, I think, $100 million or something like that. Now it's every day. So the Fed is making sure that their problem doesn't become our problem. So they're being very proactive, and I believe it's because they want to keep on this rate hike regime until they get this liquidity bubble under control.
Yeah, I agree. And one thing reason why I said the Fed's not going to be able to, even if the Fed wants to rescue this market, which I don't think they want to do, I think they really can't. We're on that pushing on the string level now. Now, if they drop interest rates, Phil, they're not going to allow them approvals for credit. And so we're in a situation now where that we have tightening credit conditions. We peaked on interest rates. We peaked on, when I'm on just to general rates. We peaked on the S&P 500 and we peaked on commodities. So now the Fed's in a situation where even if they decide to panic and roll down their interest rates, the Fed funds rate, is that the market's still going to follow them down. There's a chart I didn't show, I'll talk to because it's kind of complicated, is that we're in a situation now where the 200 moving day averages on the 10-year, this only happens maybe, 2 or 3 times a decade, where when it hits this situation is you get a rapid flush in the 10-year. And Powell is ignoring that. They're doing whatever they can. They're keeping these interest rates higher. He's not allowing it to go down. And so that tells me that they're resisting this urge to take a drink at the AA meeting. I think it's medicine time. And so I think that's why you have to be really careful here. Phil's been pounding the table on this now for over a year, that the Fed is determined to take this whole pandemic experiment off the table in terms of this became a Fed problem, and he wants to pass it back and make it a government problem again, or make it a bank problem again. And if you listen to Danielle Martina Booth, she's basically saying is that this is not what the Fed wants to be part of. They want to be backstopping banks. They don't want to be backstopping governments. And so we basically have now a war of existence between the Fed and the Treasury. And if the Fed was losing to the Treasury, you don't really need a Fed anymore. The Treasury could just create money, right? What do you need a Fed for?
Right.
And so I think this is really an existential threat to the Fed.
Yep.
And I think this is their fight back on. This is the Empire Strikes Back at the Treasury and at the political class. So it's going to be really interesting to see. We just happen to be the mice running underneath the elephant here, and hope we don't get stomped on.
I agree, Bob. And I think, like you said, I think the bond market has spoken. And I think what we've been warning, and this chart speaks to that. I mean, we've been showing this for weeks, if not months now, of what's going to come. We were just waiting for the bond shift to happen. Well, that happened 2 weeks ago now, and gold jumped, Bitcoin jumped. That safe haven hedge jumped, and that's where you kick off the typically 100 weeks. It could give or take, but and we project this red area as to what we can expect to the downside on the market. So does it get as low as 2250? that's up for debate. But the point of the matter is that we'll know within good reason with our technicals where the bottom is in the market, how it reacts. And because there's just some certain things when we get into bear markets, where the bottom is. But be prepared, though. Be prepared for a market that isn't used to going down for this long. And typically when bear markets go past 200 to 300 days in length, typically they're going to go at least 400 to 500 days. Okay, so that's well over a year. You could say the bear market started beginning of 2022. So we could easily be into 2024 before this thing finally gives us a bottom. And that's going to be for most everything, with the exception that gold and Bitcoin typically, and I speak to gold because historically that's all we have, because Bitcoin's the new kid on the block, but gold will bottom 6 to 8 months before the market does. And that's why we say it outperforms in the bear market. So yeah.
Yep, totally agree.
All right. Well, thanks, Bob. Awesome information as usual. Thank you guys for watching. Thanks so much for all the likes and the comments and the views. We've been noticing that the views have been jumping up on the channel. We really appreciate that. And so if you could just smash that notification bell and set it for all, that really does help out the channel. And we'll keep bringing you this content. So until tomorrow's video, take care, guys. And thanks for watching.
Great. Have a good night.
Trade Genius.